Good morning. Oil and gas markets are in full crisis mode, with crude up 13 to 15% in just 2 sessions. Brent is trading at 83.38, up 7.3%. Henry Hub is at 313, up 5.6%. The catalyst is a 1-2 punch. Qatar's LNG facility is dark, and Middle East supply routes are effectively frozen. QatarEnergy's production halt has no clear timeline, and European gas prices are up roughly 70% in 2 sessions. Asian spot LNG markets are repricing in real time as buyers scramble for supply that simply isn't there. Asian refiners are weighing crude run rate cuts of up to 30% due to frozen Persian Gulf flows. State majors in China, South Korea, and Japan are most exposed, and any demand destruction would only partially offset the supply shock driving this crisis. Middle East VLCC tanker rates hit an all-time high of over $420,000 per day on the key Middle East to China route, more than double normal rates, effectively acting as a hidden tax on every barrel that does move. The White House is working on mitigation options, but Secretary Rubio confirmed no immediate strategic petroleum reserve release. The market got zero relief from that disclosure. Talos Energy is planning an appraisal well for its Daenerys discovery in the Gulf of America in Q2. Wood Mackenzie called it a game changer, and spud timing will be the next key catalyst to watch. Chevron has completed a third gathering pipeline for Israel's Leviathan field, pushing capacity to roughly 494 billion cubic feet per year. With Qatar offline, Eastern Mediterranean supply just became considerably more strategically valuable. UK tax authorities are challenging the Petrofac CBI deal over national insurance disputes for offshore workers covering a 15-year window from 1999 to 2014. Deal uncertainty worth tracking for anyone with exposure. China is actively pressuring Iranian officials to keep the Strait of Hormuz open and halt tanker attacks. The pressure is coming through senior Chinese energy executives with direct government ties, which in the Chinese context signals very high-level backing. Beijing's motivation is simple. China is the single largest buyer of Persian Gulf crude and LNG, and every day Hormuz is disrupted hits the Chinese economy hard, and China holds enormous leverage over Tehran as Iran's primary oil customer. If Beijing's pressure works, it could be the single factor that puts a ceiling on this price spike. If it fails, or Iran retaliates against Chinese-connected vessels, this crisis enters a far more dangerous phase. Sources for today's briefing include Baker Hughes, the EIA, SEC Edgar, Rig Zone, OilPrice.com, Oil and Gas Journal, FinHub, and company filings. Analysis by AFE Leaks. Full analysis at AFE Leaks.substack.com. Subscribe for the daily briefing.